Good afternoon to all. I am J. Sarani, Assistant Professor, Tirupati College. Uh, we are going to discussing about the credit and risk management in banking. The basic principles and approach of bank credit. The basic principles of bank credit are built on the foundation of safety, liquidity, profitability, and purpose of bank must ensure that the borrower has ability and willingness to repay the loan on time. This involves evaluating the borrower, financial nature of the business, character, and capacity. The loan must be used for a product and a legal purpose. The approach included detail lending risks are guided by the both commercial judgment and regulatory directives from the RBI. 3 C's are credit and operate in lending. 3 C's are character, capacity, and capital. Forming the foundation of credit appraisal. Character refers to the borrowers. Trustworthiness and willingness to repay. The loan from business or personal income. Capital is the borrower financial strength indicated by assets, net worth, and equity in the business. Banks assess the three through financial strength and credit history and personal interviews. A strong profile in all three indicates credit risk. Various types of security in bank credit. Security in bank credit serves as a safeguard against a default. There are two types: primary security and collateral security. Primary security is the asset created out of the loan, like machinery, stock, or a vehicle. Collateral security includes other assets like land, building, fixed deposit, or third-party guarantees. Banks may also accept the movable or immovable property. Depending on the loan's type, security reduces the risk and gives the bank the right to recover its due by liquidity the asset in case of non-payment. The classification of credit based on loan purposes. Loans are classified based on purposes into 5 categories: trading, manufacturing services, agriculture, and personal loans. Trading loans are offered to retailers or wholesalers for inventory purchase. Manufacturing loans are used to set up or expand industrial units involving machinery and raw material. Services sectors loans are granted to business like hotel, transport, and healthcare. Agriculture loans are crop, cultivation, irrigation, and farm machinery. Personal loans are for individual needs like education or marriage. Each category requires different assessment methods and risk evaluation. Compare and contrast demand loan, cash, credit, overdraft, and term loan. Demand loan is repayable and bank demands and is suitable for short-term needs. Cash loans allow the borrower to withdraw funds to a limit against stock or receivable. It's revolving in nature. Overdraft permits customer to withdraw when their bank balance often used by business and individuals. Term loan. There are 3 types of loan. The loan is sanctioned for a fixed term and repaid in installment, often used for a credit type has a distinct features in terms of duration, repayment structure, interest, and security. Security is of management experience and technical qualification in lending. Banks evaluate the business experience and technical qualification of borrowers. As part of credit appraisal, experienced borrowers are more capable of handling business challenges, ensuring the project success and loan repayment. The technical qualification indicates the borrower's knowledge. Especially manufacturing and technology-driven sectors. Moreover, the professional management adds value through the strategic planning, risk management, and operational efficiency. A capital term reduces the risk or business failure which enhance the creditworthiness of the borrowers. Legal and regulatory aspect involving bank credit. The bank lending is governed by laws like Indian Contract Act, the Consumer Product Act, Company Act, and Surface Act. Indian Contract Act. What is meant by contract? Contract is not one person to another person. Proper taker, bank must issue legal document section, loan agreement, market deeds, and hypothecation agreements. Loans to companies, securities board resolution, registration of charges with the register of companies. The Reserve Bank of India RBI issued the directive regarding clearly sectors, lending, exposure limits, credit risk classification, and the recovery of compliance with the legal and regulatory frameworks ensure the enforceability and reduce risks. What are the key documents required in loan processing? Loan documentation include legal and operational documents. Key documents of loan application, sanction letter, loan agreement, promissory note, hypothecation deed, market deed, and guarantee forms. Banks also collect KYC documents. KYC full form, know your customers. So income proofs. Bank will be provided on the loan to customers income level based. And valuation for security loans for corporate borrowers board resolution and ROC charge registration forms are needed. Proper documentation safeguard the bank's legal rights and form the basis for recovery in case of default. The rules of tandem core and nine committees in credit policy. The tandem committee 1975 laid down norms for working capital, financial and introduced the concept of maximum permissible bank finance. It emphasizes the inventory control and the borrower's margin contribution. The core committee recommended improvements in the credit discipline and credit monitoring. It promoted financing over cash credit. The Nayak Committee 1991 focused on small scale industries and recommended working capital limits based on the turnover 20% projected sales. This committee shaped the Indian modern credit appraisal and monitoring framework. RBI guide banks in credit operation. The Reserve Bank of India plays a central role in regulating bank credit. It issues directives on priority sector lending, interest rate structure, loan provisioning norms, and the exposure limits. RBI mandates the guidance for against and managing non-performing assets, risk classification and reporting. Through monetary policy tools, RBI control credit flow in the economy. It also provides the guidance for digital lending, customer service, and grievance redressal. Compliance ensure the financial stability, transparency, and protection of public interest. Procedure and legal requirement for lending to individual borrowers. Banks often lend to individual for personal loans, home loans, vehicle loans, education loans. For granting such loan, the banks the borrower creditworthiness, income stability, employment and repayment capacity. Proof of identity, PAN card, bank statement, ID proof, PAN, Aadhaar. The documents and legal aspects of lending to a partnership firm. In the case of partnership firm, all parties are joined in and severely liable to the loan. Before sanctioning loan, the bank exempt the partnership to confirm the powers of borrowing. Whether the firm is registered under the Indian Partnership Act 1932, a letter of partnership signed by all partners. KYC document of all partners. Financial statement of the firm. A loan agreement must be signed by the authorized partners. In case of secure loans, property and assets documents are collected. The bank also ensures that the partners have been declared insolvent and involved in the indication that would affect the repayment. Lending to a limited company involves a